All right, Ulta Beauty, ULTA, on where is that one? New York? Probably New York. Let's call it New York. Well, let's be accurate. Give me 1 second here. It is on NASDAQ. Okay, fair enough. Okay, so this is a cosmetic company. They have salons that they run, and they also have a line. Ulta Beauty's the line, and they would sell it in a drugstore, department store, etc. But they also run these salons. Okay, so there's a lot to unpack here. I'm going to try and be brief. Bottom line is, if you want to skip the whole thing, I think you should enter it, but enter it cautiously, meaning take a small position. The last quarter they put out, investors hated this. It went down from 337 to 237 in one day. $100 off the shares at a base of 337. So I can't do that math in my head. I'm sure I could work that out, but you get the idea. It's down a lot, and I do have some numbers for you in terms of, and I know it's basically been flat since that time, and it was down 30% in the last 3 months. So it was probably down about 30% that day, and it's just kind of been flat ever since. Okay, and it looks like earnings are about to come out. I'm not trying to make an earnings call. I just don't do that, but I just think it's a good company, and you should probably be taking a little bit of a nibble here. And let me tell you a little bit more why. Okay, so first thing I got to get out of the way is this accounting issue, and it's not the company's accounting issue. It's a rule change in the way you have to do international accounting. So if you first look at our model and you go, oh wow, that's a good company, it certainly is, good returns, in fact been improving since about 2009, almost every year. Maybe a little bit flat in the 2013 to 2016, and then bumped up to about 22%. Okay, so that's great. That's a great profile right off the top. Great company. Stocks reacted in kind with those returns. That makes sense. Where it gets confusing is you see this big bump in capital at the bottom here. 47% gain in capital, or growth in capital. And then that hurt the returns, went down to 19%. Okay, a couple of things. First of all my clients, my institutional clients, would go, oh, that's not great. You don't put in capital to get a worse return. You want to get, hopefully a better return. Ultimately the best is put in more capital, get a higher return. That would be amazing. Of course, that opportunity set doesn't always exist. Okay. This is one where you got to make an exception because it's an accounting rule only. You may look at 47% growth and go, oh, that's okay even if it turns down. Or you may go, oh, that was probably an acquisition. That's what most of my clients would do. In fact, that's what I did. And then I dug in further and I realized, oh, there was an accounting rule change, international standards saying you have to capitalize your leases now. So any leases that were run just through the income statement and not as an asset on the balance sheet must be capitalized, even if you don't technically own it, and put on the balance sheet, because it's just a financing decision, right? Whether, if you have to have a store, or in this case a salon, and you can buy it or lease it, the economics are the same. You need that place. It's an asset. Okay? So I actually think this is a good change. I prefer to have that lower return on the correct amount of assets and get accuracy. Ideally, I'd like to restate all of these, but that's not going to happen. They're not going to go back and restate. But anyways, so let's listen. I know I'm long-winded here, but this is important. Theoretically, investors look through this kind of stuff, right? They say, oh, they would have looked at the older ones that were earning 22% or whatever and said, oh, we got to capitalize the lease, so we'll make an adjustment to the return, and the return is more like 19, like the new quarters. Okay, but realistically, even with computers and AI and data providers, and it's not so easy to just recognize we have to capitalize the lease on this one automatically without the company doing it in their financials. So, but now that was again long-winded. That's not the reason the stock dropped. Because theoretically, investors had already accounted for that. They already knew this. And so what happened? Well, it was a high growth stock. And it kind of didn't grow as fast as it was growing. And the margins compressed. So that 19% return is not because of okay, so I'm going to double talk here. There is some weakness in the business relative to what it was, but it's actually still a very good business. Rolling over, by the way, even rolling over from 22 to 19 is not the end of the world. That's kind of a first world problem to have. But we do want them to go higher. So what did investors see that made them take the stock down? Okay, and we got to jump in here and dive in a little bit deeper. So here's the stock rolling around, or the revenue rolling along at 22, 17, 15. So it's kind of, I guess, trickling down a little bit, but it's it's a high base, so it's not quite growing as fast. And then the